The IRS is going to charge you a penalty, and most self employed people don't even know why. I'm talking about unexpected tax bills, IRS penalties, and that sinking feeling when you realize you owe thousands of dollars you didn't plan for. Today, I'm going to explain exactly what quarterly taxes are, who has to pay them, how to calculate what you owe, when the deadlines are, and what happens if you don't pay. By the end of this video, you're going to have a complete picture of how quarterly taxes work and a clear plan for what to do next. Hey, I'm Paulette with PRF Tax Service. I help freelancers, gig workers, and small business owners navigate taxes without the stress year round. If you're new here, hit that subscribe button because I post new videos every Tuesday and Thursday, and every single one is designed to save you money and keep you out of trouble with the IRS. Let's get into it. First, what are quarterly taxes and why do they exist? When you work a traditional job, your employer withholds taxes from every single paycheck. Every 2 weeks or every month, a portion of what you earn goes straight to the IRS before you ever see it. You don't have to think about it, it just happens automatically. But when you're self employed, whether you're a freelancer, a gig worker, an independent contractor, or a small business owner, nobody is withholding taxes for you. Every dollar you earn comes to you in full. No withholding, no automatic payments to the IRS, which means it's entirely your responsibility to set money aside and pay the IRS yourself throughout the year. The IRS does not want to wait until April to get paid. They want their money as you earn it. So they require self employed people to make estimated tax payments 4 times a year, once each quarter. These are called quarterly estimated tax payments, or sometimes just quarterly taxes. If you don't make these payments, or if you underpay, the IRS charges you a penalty, and that penalty adds up on top of whatever you already owe. We'll talk more about that in a few minutes. Now, who actually has to pay quarterly taxes? The general rule is this: if you expect to owe at least $1,000 in federal taxes for the year after subtracting any withholding and credits, you are required to make quarterly estimated payments. This applies to freelancers, independent contractors, gig workers, small business owners, sole proprietors, and anyone who receives a 1099 form instead of a W 2. It also applies to people who have a side hustle in addition to a regular job, if that side hustle income pushes their total tax liability high enough. If you're brand new to self employment and this is your first year, you may or may not owe quarterly taxes depending on how much you earn. But once you're consistently making money from self employment, you need to be making these payments. Now let's talk about what you actually owe. Quarterly estimated taxes cover two things. First, your income tax. Just like an employee pays income tax, so do you. The rate depends on your total taxable income and your tax bracket. Second, your self employment tax. That's the 15.3% for Social Security and Medicare that we talked about in a previous video. Both of these need to be factored into your quarterly payments. So, how do you calculate what to pay? There are two methods the IRS allows. Method one is called the safe harbor method. This is the simplest approach and the one I recommend for most people who are just getting started. Here's how it works: take what you paid in federal income taxes last year, your total tax liability from your prior year return, and divide it by 4. Pay that amount each quarter. If you do this, the IRS will not charge you an underpayment penalty, even if you end up owing more at the end of the year. It's called safe harbor because it protects you from penalties regardless of what your actual tax bill turns out to be. For example, if your total federal tax liability last year was $8,000, you would pay $2,000 per quarter. Simple. Method two is to estimate your actual current year tax liability. This means projecting what you expect to earn this year, subtracting your deductions, calculating your estimated tax, and paying 25% of that each quarter. This method is more accurate if your income has changed significantly from last year, either a lot higher or a lot lower, but it requires more math and more attention throughout the year. Either method works. The safe harbor method is easier and protects you from penalties. The actual calculation method is more precise, but takes more effort. Now, when are the quarterly tax deadlines? This is where a lot of people get confused because the quarters are not evenly spaced the way you might expect. Here are the four deadlines for the 2025 tax year. Quarter 1 covers January 1st through March 31st, payment due April 15th. Quarter 2 covers April 1st through May 31st, payment due June 16th. Quarter 3 covers June 1st through August 31st, payment due September 15th. Quarter 4 covers September 1st through December 31st, payment due January 15th of the following year. Write these down, put them in your calendar, set a reminder 2 weeks before each one so you have time to pull the money together. Missing these deadlines is one of the most common and most avoidable mistakes self employed people make. And how do you actually make the payments? The easiest way is through the IRS website using a service called IRS Direct Pay. It's free, it's fast, and there's no account required. You just go to irs.gov, search for Direct Pay, enter your information, and make the payment directly from your bank account. You'll get a confirmation number. Save that for your records. You can also pay through the Electronic Federal Tax Payment System, which is called EFTPS. That one requires you to register in advance, so if you want to use it, set it up now before a deadline sneaks up on you. Some people also mail a check with a payment voucher called Form 1040-ES. That works too, but electronic is faster and easier to track. Now, let's talk about what happens if you don't pay. If you skip quarterly payments or significantly underpay, the IRS charges an underpayment penalty. This penalty is calculated based on how much you underpaid and for how long. It's not a fixed amount. It's a percentage that accrues over time, similar to interest. For 2025, the underpayment penalty rate has been around 8% annually. That might not sound like a lot, but it adds up, especially if you're underpaying by thousands of dollars across multiple quarters. On top of the underpayment penalty, if you owe a large balance at the end of the year and can't pay it all at once, you could face additional interest and collection actions from the IRS. This is exactly the situation we want to avoid. The good news is that penalties are completely avoidable if you stay on top of your quarterly payments. Pay on time, pay enough, and you will not owe a penny in penalties. One more thing I want to address: what if you can't afford to pay? This is more common than people think, especially early in self employment when cash flow is unpredictable. If you genuinely cannot make a quarterly payment, pay what you can rather than nothing at all. Partial payments reduce your penalty even if they don't eliminate it entirely. And going forward, the single best habit you can build is setting aside a percentage of every payment you receive into a separate savings account designated for taxes. A good starting point for most self employed people is 25 to 30% of every dollar you earn. Some people need to set aside more depending on their tax bracket and situation. But the key is to do it immediately when the money comes in before you spend it on anything else. Out of sight, out of mind. When tax time comes, you'll have the money ready and you won't be scrambling. Let me give you a quick summary of everything we covered today. Quarterly taxes are estimated tax payments that self employed people are required to make 4 times a year. They cover both income tax and self employment tax. You owe them if you expect to owe at least $1,000 in federal taxes for the year. The easiest way to calculate them is the safe harbor method. Take last year's tax bill and divide by 4. The four deadlines are April 15th, June 16th, September 15th, and January 15th. Pay through IRS Direct. Pay at irs.gov. Set aside 25 to 30% of every dollar you earn to cover your tax bill. And if you skip payments, expect to pay penalties on top of what you owe. If this felt like a lot, that's okay. This is exactly the kind of thing I help my clients navigate one on one. I have free 15-minute consultations available, and the link is in the description. Let's look at your specific situation together and make sure you have a plan. And if you haven't grabbed the free tax savings checklist yet, that's also in the description. It's a quick reference guide for deductions that could reduce the amount you owe in the first place, which means smaller quarterly payments. Drop a comment below and let me know. Did you know about quarterly taxes before watching this video? Or is this brand new information for you? I want to know where you are. I read every single comment. Subscribe if you haven't already. New videos every Tuesday and Thursday. I'll see you in the next one.